We are used to evaluating the Chinese economy through the lens of sheer velocity and industrial expansion. But underneath the output data, a quieter, mechanical shift has taken hold. In 2023, China officially crossed the threshold into what demographers classify as an aged society. This chart plots a country's fertility rate against its income per capita. Notice the steepness of the drop here. China's demographic transition is unfolding at a noticeably faster pace than its East Asian peers, like Japan or the Republic of Korea. Look at where the crossover point happens on the dependency ratio. Japan and Korea hit this threshold when they were already high-income economies, possessing the accumulated wealth to service an aging population. China is crossing this threshold while still classified as an upper-middle-income country. Its demographic window, the period where the working-age population outnumbers dependents, has closed. This is a structural macroeconomic anchor. It alters how the state must generate tax revenue and manage domestic consumption, as the ratio of workers to retirees shifts. To calculate the exact economic cost of this aging population, we have to track its impact across three specific mechanisms: total factor productivity, aggregate savings, and the inequality gap. A strong quarter of manufacturing exports or temporary fiscal stimulus can briefly mask weaknesses in these areas, but those are cyclical wins. The underlying trajectory is tracked by a single metric: the old age dependency ratio. This measures the number of elderly citizens relying on a shrinking base of working-age adults. As this ratio rises, it mechanically rewires China's growth model. Demographic gravity exerts a persistent drag on long-term potential, regardless of immediate monetary or fiscal policy adjustments. The most immediate consequence of the demographic shift is the contraction of the working-age population share. The deep pool of surplus labor that historically gave China its cost advantage is largely exhausted. This labor shortage is artificially accelerated by statutory retirement ages set back in 1951, currently 60 for men and as low as 50 for female blue-collar workers. Beyond labor, the demographic shift severely limits capital. Standard economic models assume people save while working and spend down those savings in retirement. Household data indicates that older cohorts in China do still save. However, they save at significantly lower rates than prime-age workers who are at the peak of their earning power. This flowchart maps the downstream effects. Rising old age dependency directly links to declining aggregate household savings, leaving fewer resources for capital formation. Transitioning to historical drivers, the footprint of labor and capital is shrinking. Over the last decade, their GDP contributions steadily compressed. Without deep reservoirs of aggregate savings, the domestic capital required to rebalance the economy, shifting away from a reliance on property and exports towards high-value consumption, becomes remarkably scarce. Growth relies on how efficiently a country combines its workers and machines. This is total factor productivity, or TFP, and aging introduces a distinct TFP penalty. Older workforces generally exhibit a lower appetite for entrepreneurial risk. Because they have shorter time horizons to reap the benefits of new skills, they have less incentive to invest in intensive training. This line graph plots the relationship between age and productivity in China. We see an inverted U-curve, where the highest productivity contributions peak among workers aged 50 to 59, followed by a severe drop-off for older cohorts.
To offset this penalty, the state has launched a massive technological counteroffensive, relying heavily on automation. The scale of this intervention is massive. In 2022, China installed more than half of all industrial robots deployed globally. Simultaneously, the state is aggressively pushing human capital accumulation, ensuring younger cohorts entering the labor force are significantly more educated than the generation retiring out of it. But physical capital has diminishing returns. Productivity loss is a structural limitation. Adding more robots to a factory floor can blunt the impact, but it cannot completely replace the specific innovative capacity of a young, dynamic workforce. At the macroeconomic level, aging slows down output. At the microeconomic level, it acts as an aggressive multiplier on the country's wealth gap. By the time citizens reach retirement, socioeconomic disadvantages, such as educational disparities and the urban-rural Foucault divide, compound. This dual bar chart exposes the structural disparity in China's safety net. On the left, the massive enrollment in the rural-urban resident scheme. On the right, the payout. The average rural benefit is less than 6% of the urban employee system. Today, 55% of China's pensioners rely entirely on this severely underfunded rural system. This income disparity is immediately amplified by out-of-pocket healthcare costs. Because the depth of medical insurance varies sharply by occupation and geography, health expenditures act essentially as a regressive tax. For low-income elderly households, these costs consume a disproportionate share of their total monthly expenditure. The financial strain is severe enough that enrollment in basic resident medical insurance has actually declined in recent years, driven by an inability to pay the rising premiums. When a rapidly aging population collides with a bifurcated social safety net, the underlying economic math is simply unforgiving. Without immediate state intervention to equalize benefits, the wealth gap will persistently widen. Both the macro growth drag and the micro inequality crisis eventually flow to the exact same place, the state's balance sheet. This area chart tracks the financial health of the Social Security Fund. The expanding shaded section illustrates the steady climb of the fiscal subsidies required just to keep the system afloat. By 2023, direct government subsidies were already accounting for over 20% of the Social Security Fund's budget. Without structural reform, researchers have warned these funds could be depleted as early as 2035, leaving the state to bridge the gap through significantly higher borrowing or difficult benefit cuts. Absorbing this accelerating demographic cost severely restricts the central government's fiscal capacity. Every yuan spent propping up the pension system is a yuan that cannot be deployed for economic stimulus or bailing out struggling industrial sectors. To prevent demographic gravity from permanently stalling its economic rise, the state has to execute a critical dual mandate. First, it must relentlessly offset the loss of labor and productivity by pivoting toward high-tech, low-labor, advanced manufacturing, like the rapidly expanding electric vehicle sector. Second, it must execute politically and financially expensive structural reforms. That means raising statutory retirement ages to keep people working longer, and equalizing pension adequacy to protect the rural elderly. Unless this dual mandate is met, demographic gravity will act as a persistent ceiling on China's long-term potential growth.